Did you notice it? Did you notice the collision this week?
Look, we have a lot of oil, but we can't get it to the right place. And that's what worries the market. You can't get it through that checkpoint.
That's correct. We have that Strait of Hormuz where 20% of the oil goes through.
Because several forces in the global economy just collided.
Oil prices shot back up to over $100 a barrel overnight as Iran focuses more of its attacks on fuel, tankers, fuel depots, infrastructure across the region.
Oil markets, geopolitics, inflation expectations, and bond markets. And when those forces collide, it's like the swell building beneath a storm before it breaks, and your mortgage rate moves with it.
Mortgage rates are going up again across the country this week as investors weigh the economic impact of the war in Iran.
Yeah, and right now, nearly 20% of the world's oil supply moves through a single shipping lane called the Strait of Hormuz. And if that route becomes unstable, energy markets react immediately. Oil prices move, inflation expectations shift, bond markets react. And when bond markets react, mortgage rates move.
So the real question becomes, if geopolitical tensions, energy markets, inflation expectations, and bond markets are all colliding at the same time, what does that mean for mortgage rates in the housing market right now?
Welcome to the Mortgage 101 podcast, where we break down the economic forces that are shaping housing and mortgage rates so buyers like you can understand what's really happening behind the headlines.
Look, ultimately, it's the American public who is going to decide if this is a major issue. What are you learning from some of the numbers you've been looking at as to how people really feel about this?
Yeah, I mean, look, you can bloviate as much as you want in Washington, D.C., but at the end of the day, it's the American people who make the ultimate decision.
Because today's housing market isn't being shaped by just one factor. It's being shaped by multiple forces hitting the system all at the same time. Global conflict, energy markets, inflation expectations, housing supply, and bond market volatility.
Yeah, mortgage rates ultimately follow the 10-year Treasury yield, and that yield moves based on how investor prices inflation and the risk in the global economy, which means sometimes the biggest forces affecting mortgage rates aren't happening in the housing sector at all.
So how long is it going to take?
I hope it's a couple of weeks. I hope the president is right. We're all cheering for the president. If we get it done within a couple of weeks, no problem. And of course, the inflation rate. We get a CPI report this week. But you and I are cheering and hoping it just lasts and it's over before the end of the month. It'll be much about ado about nothing if it's over before the end of the month. But if it extends for many, many months, then we have a problem.
Each one of those forces can move markets on its own. But when they collide at the same time, that's when the mortgage market begins to feel like the perfect storm.
And if you enjoy breaking down the economics behind the housing market, make sure you like, follow, and subscribe. And every week, we help buyers like you understand what's actually moving mortgage rates.
So today, we're breaking down what we are calling the perfect storm. First, we'll explain the global forces currently forming around the housing market. Then we'll break down how mortgage rate machine actually works, because most buyers misunderstand it completely. And finally, we'll talk about how buyers can navigate a market filled with headlines, predictions, and misinformation.
Because when you understand the instruments guiding the market, you're far better equipped to navigate the storm.
The roller coaster ride continues that we've been on for the better part of the last 10 days, and we are unfortunately all becoming oil traders. The problem is that the real professional oil traders right now are not even confident on what they've relied upon in the past.
So, before we talk about buying strategies or mortgage rates, we need to understand the storm forming around the housing market right now. Because today's market isn't being shaped by just one economic factor. It's being shaped by several powerful forces hitting the system all at the same time. Mortgage rates, global energy markets, housing supply, consumer debt, each one matters on its own. But when they collide together, that's when the market begins to feel like a perfect storm.
Take energy markets as one example. Over the past few weeks, tensions involving Iran and shipping concerns around the Strait of Hormuz have increased volatility in oil markets. That matters because roughly 20% of the world's oil supply moves through that single shipping corridor. When that corridor becomes unstable, energy markets react quickly. Oil prices have recently pushed back towards the $100 per barrel range. Energy costs feed directly into inflation, and inflation expectations, they influence the bond market, which ultimately drives mortgage rates.
Housing supply is another pressure point. The United States currently has an estimated housing shortage of about 3 to 5 million homes. At the same time, roughly 60% of homeowners today have a mortgage rate below 4%. That creates what economists call the lock-in effect, where homeowners choose not to sell because moving would mean giving up a much lower mortgage rate. The result is fewer homes entering the market, which keeps the supply tight even when demand slows.
Consumer debt is another factor shaping the market. Americans now carry over $1.2 trillion in credit card balances, around $1.6 trillion in auto loans, and another $1.7 trillion in student loan debt. Those numbers matter because lenders evaluate something called the debt-to-income ratio, or DTI for short. Higher debt levels can reduce the amount of mortgage a buyer qualifies for, which directly impacts affordability.
So, when you step back and look at the bigger picture, you begin to see the storm forming. Global energy volatility, housing supply shortages, rising household debt, and a bond market reacting to inflation expectations. Each of those forces influences the housing market, but when they collide at the same time, that's when buyers begin to feel like they're navigating through a storm. And to understand how to navigate that storm, you first have to understand how mortgage rates actually move.
Jesus, Bill, I've never seen clutter like this.
I don't think anybody has. Prices are high.
Bill, we're in the core.
Okay, we got sisters.
So let's talk about something that confuses almost every buyer in today's market. What we call the misunderstood rate machine and what it actually means for people currently in the hunt for a home. Because most buyers believe one simple thing. If the Federal Reserve lowers interest rates, mortgage rates will drop too. If the Fed raises rates, mortgage rates will rise. But that's not actually how the system works. Mortgage rates don't directly follow the Federal Reserve. They follow something much bigger.
That's right, and mortgage rates are driven primarily by the bond market. More specifically, they're closely tied to the 10-year Treasury yield. That yield acts as the baseline for long-term borrowing costs across the entire United States. Mortgage loans are packaged into investments known as mortgage-backed securities, or MBS for short. Investors buy those securities because they provide long-term income streams, but investors only buy them when the return is competitive compared to the other bonds. So when bond yields rise, mortgages typically rise as well.
And this is where global events begin influencing mortgage pricing. Energy prices, inflation expectations, economic growth, geopolitical conflicts, all of those factors influence how investors price risk. If investors believe inflation could increase, they demand higher yields to compensate for that risk. And when the yields rise, the mortgage rates follow.
Yeah, and we've seen that play out recently, right? I mean, over the past few weeks, the 10-year Treasury yield has moved between roughly 3.9% to just over 4.2%. And that might sound like small change, but in mortgage markets, even small movements can affect pricing big time because mortgage-backed securities, they react quickly to changes. And in bond yields, that's exactly why buyers sometimes see mortgage rates move. Even when the Federal Reserve hasn't made any policy announcement, we see this movement.
Yeah, which leads to one of the biggest mistakes buyers make. They try to perfectly time interest rates. But once you understand how the system works, you realize you're not just predicting housing, you're predicting inflation, you're predicting energy markets, bond investors, the central bank policy, and global economic events that can shift overnight.
Yeah, and that brings us back to the storm metaphor that you brought up earlier. When captains navigate storms at sea, they don't try to predict every single wave. They focus on understanding the system they're navigating. And in housing, understanding that system, it matters. Because mortgage rates are not just a housing story, They're part of a much larger global financial system. So the real question becomes, how should buyers actually navigate a market like this?
So the big question becomes, how should buyers actually navigate a market like this? Because the biggest challenge today isn't just the economy. It's the overwhelming amount of misinformation people are trying to process. Buyers today can open their phone and within seconds see a completely different prediction about the housing market. One video says housing will crash. The other says prices will surge again. Both can spread to millions of people and almost instantly, which creates information confusion, where the line between real data and misleading content becomes blurred.
One way buyers can cut through that confusion is by focusing on numbers that actually drive the economy. Inflation peaked above 9% in 2022, the highest level in more than 40 years. Today, U.S. inflation is closer to 2.4%, much closer to the Federal Reserve's long-term target of 2%. But inflation can change quickly with global events affecting energy markets. For example, tensions involving Iran right now and the safety of the Strait of Hormuz. It matters because roughly 20% of the world's oil supply moves through that corridor. And if energy prices surge, inflation expectations rise. And when inflation expectations rise, bond yields often rise with it, which means mortgage rates, they follow.
Housing supply can also play a role. The United States still has an estimated housing shortage of roughly 3 to 5 million homes. At the same time, about 60% of homeowners that have mortgages right now below 4% are creating a lock-in effect that limits the inventory. Consumer debt also matters. Americans now carry about $1.2 trillion in credit card debt, $1.6 trillion in auto loans, and about $1.7 trillion in student loan balances. Those numbers influence mortgage approvals because lenders evaluate debt-to-income ratios. Higher debt levels can reduce borrowing power.
History also shows that fear-driven decisions often age poorly in housing. After the housing crash, national home prices fell roughly 30% between 2007 and 2012. But once that market stabilized, prices increased more than 50% nationally between that 2012 and 2019. Many buyers who waited for the perfect bottom, they missed the recovery. During the pandemic, we saw this similar pattern. In early 2020, many predicted foreclosures would just flood the market. Instead, what did home prices do? They rose more than 40% by 2022, while mortgage rates later climbed from the 2% range all the way to the mid-6, upper 7 range.
Which brings us back to the storm analogy. Every generation hears the same warning during uncertain markets. Wait. Prices are about to drop. But if you ask previous generations whether housing was cheaper during their time, most would say yes. Over the past 60 years, home prices have grown much faster than household incomes. In the 1960s, the median home roughly cost 2 times the household income. Today, that number is closer to 5 to 6 times of the income in many markets. And you'll often hear buyers say, I was born 10 years too late. Well, that might be true. Your parents probably should have put on a little Barry Manilow a lot sooner for your economic benefit. But if you keep waiting for the perfect market, you're doing the same thing they did before they got here. They waited. You can refinance a mortgage later if rates improve, but you can't change the market you bought into. And the buyers who focus on real data and stay 2 steps ahead of the storm forming around them, they are usually the ones who come out ahead. But the real question becomes, what are the markets actually telling us right now?
Yeah, and speaking of markets, let's check the new Mortgage 101 market dashboard, where we dive into where rates are going, where they're at now, and more importantly, what's driving them.
Wall of water coming towards New York City. Everybody.
All right, let's check the new Mortgage 101 market dashboard and look at all four indicators driving mortgage rates right now. First, the 30-year fixed mortgage rate, which is currently sitting around 6.14%. Second, the 10-year Treasury yield, the benchmark mortgage rates tend to follow, and that's currently around 4.09%. And third, mortgage-backed securities. The bonds that fund home loans with the UMBS 5 coupon trading around 99.93 and the 5.5 coupon around 101.28. And fourth, the mortgage spread, which is the difference between mortgage rates and the 10-year Treasury, currently sitting around 2%, slightly above historical averages. Looking at the dashboard, I'm starting to think Anthony and I may have been a little optimistic about seeing mortgage rates in the low fives by year end.
Yeah, I mean, the reason that the dashboard looks the way it does comes down to the bond market, Manly. Mortgage rates follow the 10-year Treasury, as we know, and that yield moves when investors begin pricing in inflation risk. Right now, markets are watching energy prices closely, especially with tensions affecting oil supply and the Strait of Hormuz, which carries roughly 20% of the world's oil supply. When oil becomes volatile, inflation expectations rise, which pushes bond markets higher. And when yields rise, mortgage pricing usually follows. So unless inflation cools faster than expected, the path to low 5% mortgage rates this year is looking less likely right now. I mean, it's pretty crazy how fast it's flipped. I mean, that was not on our bingo card. We did not have, hey, let's change the supreme leader 10 times in a week for Iran. It just wasn't in our expectations. And, you know, like you and I talked about, the oil that U.S. uses is very little that goes out of the strait. But oil is on a global scale, so if one side tilts, the other follows. So unfortunately, this is collateral damage. Even though, you know, we're not really affected, the world is, and therefore we are. And until they get this figured out, there's going to be a lot of volatility, and that spread is really what we're seeing. We're not seeing the foundation change. We're seeing that spread change because of the volatility.
Yeah. Hey, like you said, this was not on our bingo card by a long shot. Nobody predicted this would be coming down the pipe. Now, some people say, yeah, we could have seen that a little better, or we did talk about it the night before it actually went down. We both kind of looked at it and said, this could happen, and sure enough, it did, which is very interesting. But, you know, this is creating the massive volatility in the unrest in the bond market in itself, which is having the bigger impact and why we're seeing the wild yields spreads that we're seeing. So we'll keep an eye on watching the dashboard, and we'll see whose prediction survives this storm.
Whoa, guys, look at that! Raymond! Oh my God! Yeah! Get it in!
All right, it's time for our Mortgage 101 Buzzword Breakdown. Our producer Ryan is going to throw 5 buzzwords at us that we've been hearing in the market this week. Anthony and I will break them down in plain English. Ryan, what's the storm forecast look like?
If this episode is the perfect storm, these are the waves hitting the housing market right now. First buzzword today is inflation expectations. Anthony, take it away.
Inflation expectations are what investors believe inflation will look like in the future. The bond market, it reacts to that. If the investors think inflation will rise, they demand higher yields on the bonds. And when the yields rise, mortgage rates usually follow.
All right, Manly. Buzzword number 2 is mortgage spread.
Whoa. That's the difference between mortgage rates and the 10-year Treasury. Historically, that spread averages about 1.6 to 1.8%, but right now it's closer to 2%. When markets get volatile, investors demand extra return to hold mortgage bonds, which pushes mortgage rates higher.
All right, Anthony. Buzzword number 3 is Strait of Hormuz.
Yeah, that's everything that we're seeing right now on the news. That's one of the most important oil shipping lanes in the world, and roughly 20% of the global oil supply moves straight through that corridor. So if that route becomes unstable, oil prices can spike quickly, inflation expectations rise, and bond markets reacts. which is ultimately what affects mortgage rates. And that's what we're seeing.
All right, number 4, Manley, tell us about bond market volatility.
All right, Ryan, that's when the bond market starts swinging more than usual. When investors are uncertain about inflation, economic growth, and geopolitical conflict, yields can move quickly, and mortgage rates tend to move right along with them.
All right, Anthony, you have the final buzzword for today, and it is perfect storm.
Yeah, and the perfect storm we're talking about is not the nail biter blockbuster that we're used to seeing on the big screen. A perfect storm is when multiple economic forces hit the market at the same time. And right now, you've got geopolitics, tomato, energy markets, inflation expectations, and the housing supply. And they're all colliding. And each one alone, it moves markets. But when they all hit together, that's when things get unpredictable.
And that's exactly why understanding the forces behind the headlines matters. Because when economic storms show up, the buyers who understand the instruments are the ones who navigate them the best.
You got about 5 seconds, boy! Come on, fight up!
So if today's housing market feels like a storm, remember something important. Storms in the housing market aren't new. They've existed for as long as the mortgage industry itself.
Yeah, and here's a quick fact that surprises a lot of people. The 30-year fixed mortgage, the loan most Americans use today, didn't really exist before the 1930s. Before that, most home loans were only 3 to 5 years long, and borrowers, they often had to make large balloon payments at the end. During the Great Depression, though, millions of homeowners couldn't refinance those short-term balloon loans and lost their homes.
That's what led to the creation of the Federal Housing Administration in 1934, which helped introduce the modern, long-term, fully amortized mortgage. And when those early 30-year mortgages started appearing, interest rates were roughly around 5%.
Yeah, so even though today's market feels volatile, the mortgage system we rely on today was actually built during one of the most difficult economic periods in American history.
Which means storms in the economy will come and go. But the foundation of homeownership has been built to weather them. Hey, if you enjoyed this episode, make sure you like, subscribe, and share the podcast with someone trying to understand the housing market today. And if there's a topic you'd like us to break down in a future episode, drop it in the comments and send us your feedback.
Thanks for listening to the Mortgage 101 podcast.
Now we rebuild.
Girl from the heart of Wisconsin to the waves of Hawaii. Manley and Anthony keep it real, not salesy. Breaking down rates and the truth you need to know with a little soul and a little homegrown flow. It's the Mortgage 101 podcast where real talk meets home at last. Manley's got that Midwest soul. Anthony brings that island roll when the market swings and you don't go fast. Tune in, the Mortgage 101.